next guest says he's seeing history repeat itself when it comes to the formation of yet another tech bubble. Steve Blank is a professor at UC Berkeley's Haas School of Business. He also teaches at Stanford's Engineering School and is the founder of 8 technology companies. He joins us today from Palo Alto, California. And Steve, I'm so excited to have you on the show as the oracle for entrepreneurs. You've seen so many phases in this business from 1978 when you came to Silicon Valley. How does what's happening now compare to what you've seen in other times?
Well, you know, as Yogi Berra said, it seems like deja vu all over again. Today's bubble is seemingly following the same cycle as we saw in 1995 through the year 2000. And it looks like we're about to have some interesting times again.
Now, you recently debated with venture capitalist Ben Horowitz in The Economist, a fascinating exchange of words. Horowitz says, we are not in a technology bubble. We have not even taken a major step towards a technology bubble. He's a reputable investor. Why shouldn't we listen to him?
Well, you know, Ben is not only just a reputable investor, but his firm is one of the most prescient and influential in the Valley. His partner, Mark Andreessen, essentially invented, or at least commercialized, the first browser at Netscape. So Ben made some interesting points. I just believe that bubbles follow the 4 steps that Professor John Paul Rodriguez at Hofstra articulated. And that is, they go through a stealth phase, then there's an awareness phase, then there's mania, and then there's a crash. And in the stealth phase, the smart money, the venture capitalists invests. In the awareness phase, you get institutional investors. And in the mania phase, the public, your grandmother, starts buying stock, and that's where it goes bad.
So why aren't investors agreeing with you? A number of investors that we've spoken to say, no, there isn't a bubble. Do they just not want to fess up to it?
Well, to be honest, there are a couple of categories of people who don't believe you're in a bubble. And I'll use a polite term in that one category are true believers, and the other category are people who make money off of the rest of us believing that they're in a bubble. You know, a bubble requires suspension of disbelief about the connection between some underlying value in the company and its price. And I think we've now seen waves of, or at least the first wave of startups getting out there. First, the Chinese internet IPOs last year and the beginning of this, and now Pandora and LinkedIn and soon to be Zynga. It's not that these companies are valueless. It just means that the connection between their price and their value requires a fantasy factor.
Now, what about what's happening at the earlier stages of investing? For example, Color. Bill Wynn, a great entrepreneur. We've had him here on the show, but he got $43 million from venture capitalists very early on, and people are already leaving the company. So far, it hasn't seemed to work. What's the problem there?
So I can't speak about Color directly, but it does set kind of a benchmark for early stage venture capital investments. If you think about it, the $43 million they took in was obviously for only a percentage of the company, and their valuation was rumored to be anywhere between $75 and $100 million. This is for a company that never shipped a product. You got to ask yourself, is if 2 years ago, when Sequoia Capital was writing, you know, the death of fundraising memos, whether they would have gotten a tenth of that valuation. And if your answer is, well, why no, they would have barely raised $4 or $5 million, then you have to ask yourself what's going on at the early stage capital end. And I think when you talk to investors here in Silicon Valley, they will tell you that valuations have doubled or tripled in the last year.
So how do you think this is going to play out? When is the bubble going to pop?
Well, you know, the last bubble kind of began, if we had to pick a date, at Netscape's IPO in August 1995, when the public and institutional investors essentially stopped requiring startups, at least technology startups, to have a series of increasing quarters of increasing revenue or profitability. Basically, Netscape was the first concept IPO. Didn't mean that their company didn't have value, but the valuation compared to what its revenue was just completely disconnected, which opened the spigot for the next 5 years till March of 2000 that internet companies could go public on a fairly repeatable basis. And the repeatable basis was have something about internet in your title or name, hype the company, spin it, and either flip it or take it public. And hundreds of companies went public on that basis. By the way, that's not going to be true in this first wave here.
Exactly. How bad do you think it could get if or when the bubble pops?
Well, if I knew that, I guess I'd be running a hedge fund. But I think we've seen this movie before to the extent that this first wave of companies that go public will actually have value and revenue. Zynga approaching $1 billion in revenue, LinkedIn having 100 million customers, et cetera. I'm less concerned about the first 5 or 10. I'm concerned about the next 100 or 200 tech IPOs, and when your grandmother is buying stocks in social networking companies because she heard that was the hot thing to do. That's when we have the crash. The last one lasted 4.5 years. This one could do as well or be even shorter.
We shall see. Steve Blank, great to have you here on Bloomberg West, and thank you so much for sharing your insights.